Hi folks, this is Bruce Kirsch with REFM, and here is a quick tutorial on our land seller IRR-based equity kicker model, which is a free tool available on our website under the condominium free tools section. I'm not going to go through the formulas line by line because we have the descriptions here. I do want to point out a few things though. Big picture, we have three sections. One is project level levered cash flows, which come from our top line, in this case, of net revenue before financing costs. And then we have a land seller level section where we compute the kicker amount. And finally, a project level after the land seller profit share has been paid out. We see that on the project level, we have roughly a 32% IRR. And so the question becomes, what is the hurdle rate off of which the profit sharing, or the kicker, will be computed? And so naturally, this is formatted as an assumption because it's going to be the subject of negotiation. And we'll take a look at how different levels of the threshold will impact the dollar amount that the land seller will get. For now, let's just say it's a 15% IRR. And so what happens in this section here is we compute the dollar amounts that would be paid should the cash flows achieve exactly a 15% IRR. And then we will deduct those dollar amounts that relate to the 15% level of performance and then apply a share of remaining dollars, meaning dollars in excess of the performance level of 15% IRR, to figure out what is the actual amount that the land seller will actually get. And so in this case, we will assume it's a 15% IRR hurdle, and the land seller will get 10% of all dollars of profit above and beyond those required to achieve the 15% IRR. What we do in the final section is we simply deduct from the project level levered cash flow those dollar amounts that go to the land seller, and this will give us the remaining project level performance after the kicker. A few things to note here: given that there is a kicker and the project level IRR exceeds the hurdle rate, in this case it's a 31% IRR and the hurdle rate is a 15% IRR, we will see that because this $2 million is paid out to the land seller, the dollar amount naturally that goes to the project on a residual basis is less than what it was prior, and the IRR is also less than what it was prior to the payout of that profit sharing. So on a net basis, the profit to the cash equity investors after the kicker was $31.8 million. When we take a look at the graph, we see the divergence between these two levered cash flow lines, the blue line being before the payment of any kicker and the red remaining levered cash flow after the payment of the kicker. So naturally, if we were to change this input and the share input, we should see these lines change. So if we were to take it down to a 0% share, the after and the before are equivalent to one another. If we were to take it down to a 0% IRR, what we'll see is the after line will in essence begin sooner than it is currently. Okay, and that's because we start to exceed the 0% IRR sooner than we exceed anything above 0% IRR. Thanks for watching, and be sure to take full advantage of all of the free tools that we have both on our blog and on the website getrefm.com.